and welcome to the Investing Master Series. My name is James Boyd. Alongside of me is Barbara Armstrong in the chat. You know Barb. She teaches our trading a smaller account on Monday and Friday, and we welcome her and all of you here today. We got with us JP with us, David with us, Lena with us, Trader Joe, WW or Will W, Jump In, Joe A, Elena, and many others. Welcome and good morning to all. Today's date, February 3rd. If you're in snow and ice, just realize it can't last forever. That's what I used to say to myself when I lived in upstate New York in the wintertime. And eventually it thawed out. Eventually. Now, just real quick, remember that Barbara and myself, all of us coaches, we do post educational content on X. There's my handle. Barb will actually post her handle in the chat. That way you can click on it and just follow her as well. Quick reminder that as we get going, remember that we'll talk about stocks, but occasionally we will bring up options. Remember that options carry a high level of risk and are not suitable for all investors. Also remember the information provided here is done for general informational purposes only. Our examples will be done on the Paper Money software application of the Thinkorswim desktop version. Also, when we talk about investing involves risk, including loss of principal. So the investor is trying to take some risk for a potential return, but knowing that there's risk. And also remember when we talk about, let's say, short options like covered calls or short puts in general, cash secured puts, those could be assigned, okay? Example given, if we did a cash secured put, assigned means we buy the shares at the strike price, irregardless if it's at expiration. It's not just at expiration. Now, also want to give us a quick reminder, if you went to schwab.com/events, you can actually see different events we have scheduled throughout the year. Some upcoming ones. Barb was just in Seattle with Ben Watson, and you can see on her page some of the pictures that they posted. She posted there, and great pictures, by the way. And also remember that coming up in February 6th and 7th, we're going to be in Sacramento, Sacktown, at the Sheraton Grand Hotel. That's a 2-day class, first day technical analysis, second day option strategies. We also have a 1-day session, San Diego Market Drive at the Marriott Marquis San Diego. That's a 1-day event, and a 2-day event. 2-day was first day technical analysis, second day actually option strategies. Now make sure when you go to that schwab.com/events, just make sure that you're clear on what is taught on day 1 and day 2 and what those events are. And I can show you that in just a sec. I'm making the assumption that that's technical analysis and option strategies. We do also have advanced concept classes as well. So just make sure is it technical analysis and option strategies or advanced concepts like advanced options. Now, remember when we actually get going, let's kind of take a look at kind of what we see in the market right now. So first off, let's kind of start with the indexes and then kind of take a look at kind of what's happening there. We need to talk about the portfolio. Now, what is it? Probably December 16th or so, we reset the paper money accounts and we started reestablishing positions. We need to talk about some of those positions as some are on the doorstep of earnings. Some might need management as well. Now, in this class, we talk about stock and option trades. So we're going to talk about both, okay? Now, first thing that we actually notice is I have the S&P 500 here. And if you look at the S&P 500, it's kind of a very odd picture so far here today. And you probably noticed. On the left-hand side, and this picture right here is based upon market cap. Market cap just being the stock price times the number of shares. Stock price times the number of shares outstanding. Think of it in terms of its equity value. Sold all the shares, common shares. What's the company worth? Well, the bigger the blocks, the more value. Well, on the left-hand side, what you're going to notice is it's not very green. That's true. Now, remember, if we're talking about the S&P 500, the comment that was made this morning, and I agree with, is that if these big names are not at least holding value minimum or going to the upside, it's probably going to be hard for the S&P to break out, SPX that is. Hold that thought for just a second. Where we are kind of seeing some shift is the staples. Now remember, when you say staples, think income, dividends, right? Notice that we're also seeing a little push in the consumer discretionary. Look at financials actually here a little bit. Keep an eye on the regional banks, okay? We actually take a look at industrials, kitty cat, meow, pushing to the upside, Illinois Tool, FedEx, my gosh, shipping themselves to the upside themselves. And you look at energy, some of these energy names are not falling apart. Exxon, Chevron, ConocoPhillips. Some utility stocks are getting a push. And we're also seeing here in the bottom left-hand side, small market caps, some of these material stocks rebounding quite a bit. So the first thing is, we're not just looking at the entire market as the same here. Now, remember the comment I said, if those bigger names are not moving to the upside, it's probably going to be hard for the S&P to break to the upside. It makes sense because the SPX is really founded on three main sectors that almost are 50% of the performance. 50%. By the way, what are those? Well, one's tech, one's discretionaries, one's financials, okay? It's not quite 50%, but it's close in those three sectors. So the S&P isn't broken down. We can't say that, no. Where the damage, though, has actually been done a little bit has actually been in the NASDAQ itself. And if you look at the SOX right here, you're going to see that both of those have struggled. They've been struggling, okay? Now, the bounce back, is it still in, let's say, small caps? Well, small caps trying to get a turn here. We closed above the 10-period moving average yesterday. Yes. We actually went up to the 20-period moving average. It's trying to. Classic flag, okay, that we actually see on the chart right here. And you're going to notice that it kind of has that slant down. Now, when we talk about a bull flag, your standard bull flag would probably have a diagonal resistance line of maybe 9 or 10 days. There she is. We're seeing a little poke to the upside. Now, remember, if someone wants something that moves on a higher percentage, they might go look at small caps or NASDAQ. Okay, so it's not one or the other. They might look at, they might say, hey, they don't have to both be going up. If someone says, I want something that moves more percentage-wise, potentially, small caps or tech stocks. Tech stocks are soft right now. So if the tech stocks are soft, second option, small caps. Does someone have to buy individual names of small caps? No. They might just buy something that's trying to track the index of small caps. Don't ever forget that. Now, also, when we take a look at the Dow Jones itself, we did see a brand new high on large caps. Now, wait, does the Dow have any, let's say, tech stocks? Well, let's go back and take a quick peek. We go look at the Dow and say, does it have tech stock? Yeah, it does. NVIDIA, Apple, Microsoft, IBM's even getting pushed down. Salesforce flushed to a fresh new low, and there's Amazon in discretionary and tech. But there's also a chunk of this that is not technology, but it's still influenced by tech. So tech still is a big part. Now, if I actually went back and kind of said, hey, let's take a quick look at some kind of like, are we starting to see a little rebound in silver? Now, you got to remember, for some people that wanted to get into silver, gold in some of these areas, they might have been looking for a pullback. Now, sometimes we want a pullback, but when the pullback comes really, really quick, now we're scared, okay? Now, some people, they're like, look, my holding period is not for the next 2 or 3 days. I want to hold for 2 or 3 months, a year, 5 years, 10 years, whatever. This might be rollback pricing. It went on sale. Now, it doesn't mean it's not going to be volatile. It is. And some people might use that volatility to try to get a better premium to a lower break even and so on. Keep an eye on actually silver starting to show a little contraction. When we talk about, let's say, oversold gauges, and they would probably be more appropriate on a 3-year weekly, we cannot even see on this chart. On the weekly, it's not really going to show oversold territory yet. It's not. It hasn't even gone negative MACD yet, okay? So that's going to be hard to say a comment like, quote, it's oversold. I can't say that. But it definitely went for a ride. Gold, if we actually take a look at that, up 300, but who's counting? Gold actually went down to, let's say, this horizontal support, 46 and change. Decent bounce back, okay? Some people like, or Lisa does, Lisa likes those long, lower shadows, also known as tails. That's where some of those who were short might cover by buying and pushing the price up. That also could actually be started by those who wanted to get in, start to get in, and they buy at and or near support areas. And they push it right back up. So far, we got a bullish engulfing candle on that. Now, also, if we went back to one other thing, I'll just quickly make mention of. This is not a fundamental class, but I think we do need to at least make mention of this. When we talk about, let's say, income stocks, value stocks, and growth stocks, which one of those is more affected, or categories, which of those three categories are more affected by rising rates? The answer we would give, and we could pull up the math of it, it's going to be growth stocks. So when you discount the company's cash flows over time, we've seen the last, let's say, 60 days, the rates have gone higher, and the higher that the rates goes, the bigger the discount, meaning that the present value of these companies, tech-wise, growth stocks related-wise, are probably going to be potentially priced lower, okay? So it's not that income's not affected. It's not that value's not affected. But growth stocks, since they have higher earnings per share, and if you get a higher discount rate, you actually, for example, you're going to get a lower present value. So if this chart keeps going up, we could get growth stocks to continue to underperform. I posted earlier this morning, income hit brand new highs. Value hit brand new highs. Okay? So remember we kind of said investing is about math? Well, one of the most foundational things of investing is discount cash flows. The higher the rates, the lower the values. Okay? Now, the one thing I also want to kind of point out just real quick is, let's go to the paid money count. Well, actually, not let me go to sectors, and then we got to look at some examples that we need to discuss, okay? So number one is, you're going to notice that basic materials, that does not look bearish. Now, you got to remember something is, when you look at IXB, it's not just gold and silver and copper. If we said, I'm not really sure what's in there, well, let's be sure, okay? If I go to just real quick where it says, let's say scan, let's go Stock Hacker for just a second, scan Stock Hacker. And if I go scan in and I go by industry, here's going to be the sector. So in this sector, we want to say, okay, we know that there's metals and mining. We get that. But is there anything else? Yeah, there is. There's chemicals, construction materials, okay, containers and packaging, and paper and forest products. So it's not just all metals and mining. Which of those, if we went back to the S&P 500, are getting a little push? S&P 500, we actually go down to materials, and we say which one is moving. But we could also say which one is not moving. Well, of course, the metals and mining are actually getting a little push, yes. But we are also seeing chemicals, Dow, LYB, containers and packaging getting a little push as well. This is how we want to use the tools to get our answers fast. Now, if we take also a look at something else that kind of poked us in the eye this morning was, gosh, dadgummit, I wasn't prepared for that. Where's my glasses? And if we take a look at the transports, okay, now let's kind of start here for just a moment. Just a moment, okay? Now, when we talk about transports, okay, now remember when we say transports, we're saying industrials. Go back to the market watch. We're going to go now to industrials. Now, again, industrials, sandwiched in industrials, we're going to say transports. Transports is to the right-hand side. There's air freight and logistics, and we're going to see passenger air, etc., okay? And we're also going to see ground transportation. That is probably what we think about when we say transportation. Now, when we see transportation, which of these are getting a little bit of a push? Well, I said before, the FedEx and UPS getting a little push there, to say the least. UPS not far behind it. Now, this is your classic accounting tool. If the business is maybe going through where margins are not as big, what do companies tend to do? They say language like, or have the strategy of, reduce headcount. I've always thought that was really weird, considering my family does cattle. Headcount to me is like cattle. Humans are not cattle, okay? I think it would be better to say reduce employees than headcount. I don't know. For me, it just sounds wrong. Now, when we also talk about, let's say, some of these names like Love, we talked about this. We have an example of this. I'm not going to go back to that right now, okay? But that actually did shoot to a brand new high. I want to go back to just real quick the one across the street, Delta. Now, if you take a look at, let's say, Delta, what you're now going to notice is we had a support, keyword, that was right at 69.16. Today, we popped above this. Now, sometimes people will say things like, well, we'll just wait and see what it's going to do. Do you realize you could say that all the time? I'm just going to wait and see what it's going to do. Wait, you said resistance was at 69. Now it gets above. Now you're going to wait and see what it's going to do, right? Well, what some investors might do more than that is they might say, look, you don't have to buy a whole position, okay? Let's say the investor says, look, I'm going to buy some of my position right here, and then what I'm going to do is on this second position, I'm going to try to add closer to support, okay? Now, I don't know, how many of you like dollar cost averaging? How many of you like that? Like getting in, not just in one area, but you like to kind of get in maybe 2 to 3 different times at different price levels. So what I'm going to do is I'm going to put the price, okay? We got 70.93. If we said the support, what I'm actually going to do is I'm going to type in 69.16. If I said the stop, which is that support, less 2%, I'm going to take this and say it's going to be that stop of 69, okay? 67.78, the stop. And remember, that stop is saying if we go down to that price, trigger it to sell. That's not saying if that's where it's going to fill. Now, let's say our position size in this case was, let's say $8,000. Okay, so when we're going to say in this case, position size. That position size, let's say we said normally it's $8,000. What we're going to do in this case is we're going to say 4,000. This is a half position, POS. This is full, okay? So if you are that person that says, look, I'm going to wait to get in when, you might say I'm going to do a half position. Now, if we kind of said the risk per share, RPS, well, that risk per share is going to be from really there down to potentially the stop. Now, why did I say potentially the stop? Well, I said potentially that 315 is, we're assuming we get stopped out at 67.78, but that's in paper, okay? Now, if we said, hey, I'm going to invest $4,000, and my risk per share is, let's say, example given, 315, it's going to tell us in this case to really do how many shares? The answer is 1,200 shares. No. Is that right? No, it's not. So if we actually did this and said, okay, price times, I'm doing this because there's been some questions on this, what's that risk? Well, it's not just the risk per share. It's what's the stock price, okay? We take a look at this and we say, okay, if I get in now at 70.93 and that risk per share is 315, if we take a look at that, that is going to be, are we doing that right? How do we do this? Now, I'm bringing this up because there's been some questions on it, okay? So if we said, well, let's just double check. There's not one way to do this. See how we're twisting it around? Well, if I said $4,000 that I can invest in 70.93, then how many shares would it be? And this is how you're probably familiar with us doing it. And I think people have turned this around. The answer is it's going to be 56 shares. Is everyone with me? That's the capital size, okay? Cap size. This is share price. This is the way we do it, okay? Cap size, share price, and the number of shares. Where people are kind of getting confused on a little bit is if I buy 56 shares, or can I buy 56 shares? Well, we have to double check that, okay? This might be too much. Based upon what? Well, it's based upon what the risk per share is. So if we actually say, look, the risk per share is 315, we got to verify if I buy 56 shares of stock based upon $4,000 and that risk per share is, let's say, 3%, how much is that potential loss? We could do 56 shares if that loss is not more than what we can take. Okay? So let's repeat this. How much are we going to invest? Half position. Second, what's the share price? 70.93. What's the number of shares? 56. 4,000 divided by 70, 56. If we had 56 shares and the risk per share is 315, if we did lose, the forecasted loss is 177. It could be a bigger loss, especially if the stock gap's down. So we got to ask ourselves, if we had, let's say, a loss of, let's say the portfolio was $40,000 loss, $40,000 account, and we said we could lose $400, are we over that amount of $400? The answer is no. So could we buy 56 shares? The answer is we could, okay? So you got to be very careful. It's not just how much money you can put on the table, so to say, to invest. It's making sure that if you do have that loss, that it's not bigger than what that percentage is. This is the portfolio value, okay? Portfolio. This is maybe a percent of portfolio. This is the loss. You're saying if I have the loss, okay? Now I want to do this, just throw this out here, and we're gonna go faster. Let's say I said I'm gonna do a full position, 8,000. And all of a sudden now let's go 10,000. I'm gonna do 10,000. And I say, okay, 10,000 is what I'm gonna do as far as invest. The stock is actually at 70.93. I'm gonna buy 140 shares. The problem, 140 shares, risk per share 315, it's gonna give us a loss of 444. We can't do that many. I'm gonna have to lower it down to where that loss is no bigger than $400. So you'd probably have to go a little bit less. If I did 135, let's just double check the math on this. If I did 135 and we're actually losing in this case, 315, now you'd have to do less. What about 125? Yeah, we'd probably be doing right around 125 shares. Okay. Now, by the way, you could just take 400 and you could actually just say $400 divided by 315, and it's going to tell us exactly how many shares it's going to be, 126. Now, I'm telling you this because if we over position size, it's not the market's fault. It's the investor's fault. So step number one, decide how much you're going to invest. Our example has always been consistent. 5 to 8% of the portfolio value that we're investing, not risking, investing. When we talk about, let's say this $400, we're saying, hey, we're going to risk, let's say, 0.5% to 1%. So it's not about, let's say, I'm going to try to make money first. What you're really saying at first is you're saying, look, I'm going to try to control the losses. Okay. So when I actually say 0.005, that's 0.5% to 0.01, 1%. It starts by not screwing it up to begin with. And what did I struggle with? I didn't do position sizing. Okay. Now what I'm going to do in this case is we're going to buy, let's go back to this, punch this in, $4,000. We're going to do in this case 56 shares of stock. Yeah, but I want more. The problem is I can't invest more. Okay. And I'm going to do a half position. I'm going to dollar cost average. I'm going to go buy custom with OCO bracket, click it. Is this a stock trade? Yeah, it is. It says it 3 times. Now what you're going to now see is if I do this, let's go bring it up right in the paper money account. Just got to make sure I put it right there. Delta. We're going to right click in the paper money account. Okay. We're going to go buy custom with OCO bracket. Here we go. Now, here's the thing is we had to make that little sheet right on point there. Could you make a sheet for yourself? Oh, for sure. Go for it. Okay. Now, where was the stop? Well, that stop, if I went back, that stop was right at 67.78. So I'm going to type that in, 67.78. Dated GTC, limit dated GTC. Now, whenever we have these prior highs or high, well, the investor's probably thinking, I'm not just going to invest for just that prior high. They might be thinking it might try to go higher. If we're trying to use the word extension, okay? Now, if we go back and look at this, I'm going to go to the resistance area, resistance, draw down to where this move started from recently, probably last 2-3 weeks, 2-3 months. So we drew it from where we had a top. And we're drawing it down to where we went down to a low, a bottom. And now what you're now going to notice is if I kind of pull it down on the right-hand side, that 161 extension is really at 82.31. Now, Of course, if you're in, let's say, airlines, you want oil to go lower. You want consumer discretionary to be high. You want people to actually have jobs. You want there to be consumer confidence. There's other independent variables that factor in the success of this trade, okay? It's not just one thing. It usually never is. Now, I'm going to go back and kind of put the target here. I'm going to put a target, let's say, at 81.25. I'm just going to say, look, if we can get within 1 to 2% of that resistance, I'm going to try to sell it, okay? So now, by the way, if we went back to the chart and we said, on this chart, do we see anything that is showing a change of trend? Okay, not trying to make it complicated, okay? Well, number one is we got the green moving average, okay? There's 10. We had the cross. That's showing the close above the high of the low day, and the 20-period moving average also went green as well. If we're trading signals, that's showing a signal. The red shading is saying no, 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 what? Well, no buying if someone says, I'm trying to trade the signal. The red shading is saying sellers are in control. And they're using the stock as a punching bag, not literally, of course, but they're knocking it down. Now, everyone go like this. Ting! The biggest actually thing is when you take a look at this, the investor's saying that sell-off could be the opportunity. Now, I want everyone to say that out loud. The sell-off could be the opportunity. I can't hear you. Say it louder. If you're around other people at Starbucks, don't turn me down. I'll just talk louder. The sell-off could be the opportunity, okay? Say it out loud. Now, here's the deal. We're going to go ahead and say confirm and send that order. When we actually go back, let's do quickly double check the Love trade. Where is it at? Love, where are you at? Love is in the IRA account. And you're going to see that it's still actually the short put vertical there, but we added to the position yesterday. Now, the one thing I want to pull up just briefly, and let me actually kind of just say this now since we're on this thought, okay? So first off, how many of you have, and you don't have to respond to this in chat, okay? How many of you have different accounts on the Thinkorswim platform or Schwab.com, right? Well, one of the nice features that they actually rolled out is if we go to the very top, go to setup, and what we're going to do is we're going to go to application settings. Now, feel free to do this on your side, okay? Setup applications settings. Now, what this does is you're now going to see something. Now, this was on Schwab.com, which I liked because most people probably have 5, 8 different accounts, okay? They got a 401k, they got a Roth, their wife has a 401k or a 503, for kids, whatever it is, margin accounts, whatever. Well, when we go set up, show that again. Let's go to setup, okay? Application settings. You're going to notice that right here, it shows account. Well, what's nice about this is it's going to list any accounts that are synced to this username and password. Now, it shows, do you have ability to do Forex in that certain account? If I'm not enrolled, I can click on that icon right there and it takes me to the page. What would I need to do to be enrolled if I wanted to, or ask for the approval, whatever. I might not be approved, okay? You're going to see that also, can I trade futures? And also if I have options, different level of clearance for different types of accounts, it might say on this account long only, but on another account, it might say level 5, short options, whatever. Do I have approval for margin, etc.? Okay. And so understand that it could have account 2, 3, 4, 5, and so on. And also what you have approval of. This is very important because sometimes when you see trade opportunities, you need to know which accounts have certain type of authorizations and abilities. Just nice that it's right here in front of us now. Nice feature. How do we find it again? Go right to where it says setup, open application setting, check it on your side, and right there. Now, if you said, hey, I would like to actually try to get approval for options if I ever consider that, well, just click on that. What does it do? As you can see, it's loading up margin and options access, And you're going to see that it shows what does it mean by different levels of approval to do covered, like long only, spreads, and how do I actually apply, okay? And wonder if I have questions and so on, right? So just, that's a nice little feature that was recently rolled out, and I know many people enjoy that, okay? Now, I want to also go back to, just real quick, one of them that we talked about yesterday. We talked about Super Target. Now, Super Target, there are activist investors that have pushed for the company to change, okay? They felt like maybe it was, not maybe, if you compared Target compared to, let's say, Walmart, Big Blue, and Target was, let's say, Big Red, not the Huskers, but you know what I mean. The big actually thing is when you take a look at this, I want to actually go back and look at this for just a second. Now, we got earnings coming up on March 4th. Now, when you look at this longer term, okay, now Target, if you take a look at this, one thing that's kind of amazing a little bit, and it's in red right here, payout ratio, 60%. Mother, okay? 60%. Now, this is where sometimes investors might be, now I want you to imagine that they had earnings per share of $1, okay? They got earnings per share of $1, and that D is for dividend, okay? The E is for, let's say, the net income. Let's just kind of put a dollar sign. This is what the company is going to keep. Well, if they're giving out 2/3 of the money back to the investor, it only leaves the company with a third of the earnings per share. Does that make sense? Now, what investors might be saying is, hey, look, we need to grow the earnings so it actually pushes down what the payout ratio is. Okay? And so really payout ratio is just 1 minus the dividend. Okay? Payout ratio, 1 minus the dividend. Okay? How much are they paying out? Or you could say, in this case, 60 cents divided by $1. Example given is 60%. That's another way you could use it as well. So investors are saying, look, we got to make some changes. You can't continue to pay out that type of money without slashing the potential dividend, because it might affect the growth prospects of the business itself and also the financial stability. Okay? I mean, how do you grow a business if you're giving all the money back to investors? Okay? This is not a real estate product. Now, in this case, what you're now going to notice is we're going to look at this, and let's go back to the 3-year weekly. This is kind of more like your longer term basing patterns. Now, here's the deal. Sometimes when the VIX goes up, right, some of the stocks that have actually gone up might go down. Sure, fine. Growth stocks especially. Some of the stocks that have not gone up with the market in general, they might go up even if the market goes down. Okay? Meaning there's not a whole lot of correlation, or hasn't been, from Target to the S&P 500. Meaning if I pull up the S&P 500, it's not going to look like Target. Low correlation, meaning. Now, what I'm going to do is let's go double check the paper money count. Is there any trade on this so far? Don't see it in the IRA. What do we actually got right here in the margin account? I don't see anything. Now, what I'm going to do in this case is we're going to go to the, let's just kind of stay with this margin account for just a second, okay? Now, if we take a look at this account is about $43,000. What did we started at? I don't know. If I remembered, which I do, I couldn't tell you anyway. So if I look at this and say, okay, so what could I risk? Let's say I'm going to risk 1% of that amount. Well, 1% of that is $428. If that account actually goes up bigger and bigger and bigger, the potential risk could actually be higher. All right. Now, if we go look at the call side or the put side, okay, that implied volatility is pretty high. Okay. When I kind of think about like levels, I've always kind of thought, and I could explain why, but if you kind of look at, let's say, IV levels, I probably think about, well, we've always kind of talked about this as kind of more like low, medium, high, okay? High does not mean better. It means the forecast is that it could be more volatile, price-wise, percentage-wise. Now, if we take a look at this, if someone says, look, I want to try to use that higher implied volatility and go to the put side, to get a bigger premium. Well, the investor might say, look, I'm going to try to sell the 105 and maybe buy a put below it and make it a short put spread. Now, this is a little wide, 30 cents. It does have volume. This is today. This is really the number of contracts that are open and unexercised. Now, again, here's the thing is a lot of investors say, I want to do something different. Be very careful when you say that, okay? We're not trying to do something different. We're trying to do something with a bigger position, hopefully, if the account grows, and we're trying to be disciplined. Now, we said if we see that the implied volatility is higher, the investor might choose a selling strategy. Now, could we, in this account, sell a put? The problem is if you sold a put, it would be too big of a position to be assigned. Assigned on a short put means buyer of the shares. Well, if we only have $42,000, and for example, it's $111, that's $11,000. That's 25% of our account. That does not pass the common sense smell test. We're going to right click on that 105, sell vertical. Now, if I do this sell vertical, we want to just double check just real quick. What's the ROR? What is the ROR? It's taking a look at what is the reward relative to the risk. Now, type in the chat what the percentage is. Well, if we got example given, 174, the maximum gain, 174, divide that by 326, it's going to be a 53% ROR, okay? Now, why is that a little bit higher? Higher implied volatility. Why is that a little higher? Further to expiration, but not over 50 days. Why is it a little higher? Well, because the short strike we're selling might be a little bit closer to the 111. That's probably not completely true. It's really probably more implied volatility in the days of expiration, okay? Now, this is an investing trade. It's a trade, but it's not, you're not doing it from the perspective of buying the shares. You're doing something where I'm trying to do a trade or an investment, if you will, thinking that the price might go up. The good part is there's a match loss. The bad part, if it goes up a lot, it caps out at 174. And so that's the bad part. The other bad part is this does not have that dollar for dollar movement as if the investor bought the shares of stock itself. Now, we're going to do two contracts. Is that true or false? All right, James. True or false? More than one contract or two contracts? Well, if we actually said we could actually risk, let's say 400 some bucks, we can only do one contract. And this is where those investors get in trouble. They're actually doing what they want to do. We're being disciplined, okay? One contract, selling one. I know we want more, but we got to start somewhere. Got to start somewhere. And now what you're going to see in this case is selling one, because if we lost the full value, it would actually be a potential loss of, let's say, $326. Now, I want to go back to just something real quick. Let's take a quick look at just real quick. Let's talk about selling, okay? Now, how many of you struggle with selling? Now, I know that not everyone struggles with the same thing. Is there anything on this graph, this table, that's kind of showing, that's like blinding us a little bit, that might be a sell potential signal? Well, eBay, okay? We see the whole moving average for the last, let's say, 3 days. We want to verify this. If the shorter term moving average is down, that could be a sell signal. If the 20 period moving average is down, that could be a sell signal. Okay, you got two strikes right there. Now let's go look at this chart and you tell me if we actually have a sell signal. Okay, now here's the thing. It's so simple to do it after the fact. I want you to tell me, okay, so all of a sudden the lines are green. It's looking fine. And now if we look at this, not looking as fine. Why? The lines on the moving average, both of them go red. That was on the 29th. And I know what we're going to say as I'll wait and see what's going to happen. But now when I go forward to the very next day, it gaps to the downside. Now, just to add salt to the injury. Well, now we're below the moving average. Does that sound bullish to you? No, it does not. Second, the lines on the moving averages are red and it's crossed down. Now remember, if we're trading based upon the trend trading rule set or swing trading rule set, was that an example of an exit? Yeah. Now here's the hardest thing for us to do. Sell. Okay? Not sell after it's down 50%, but sell when it actually is showing the signal. Now, James, why do you get so upset when you say this? So much of the pain you see in the stock market sometimes is not the market. It's that the sell signal was a month ago. Okay? And the investor fell asleep and wasn't paying attention, or they fell in love with the stock and not their own capital. How do you know that? Because I've done that. Now, here's the deal. We're going to go into eBay. Now, the hardest thing when we take a look at this, we're going to right-click on this and cancel the OCO group. We had a target and a stop. We canceled that. Right-click on that, create closing order, sell. Could this sell have been a day ago? Yes, it could have. Could we have had a little bit higher profit? We could have, okay? Is this a stock or an option trade? Well, if we just see shares only, there's no days expiration, there's no strike, anything like that. It doesn't say anything like a call or anything like that. No expiration. This is just eBay Inc. 45 shares. It's stock, okay? Right click, create closing order, sell. So the goal was to put the trade on when there was green moving averages in that shading. When there's red shading, the goal is to try to get the capital back and try to get out of the position and see if there's anything left. In this case, $217 if we can get filled, confirm send. Not a commission there. Send, fire in the hole, completes the order. Now, I could have made more. I wanted to make more. Look, we could all say that. We could all say that. Not every trade is going to be a grand slam. Now, I need help with this one. When we look at the WFC, when was that position put on? It was put on the 20th. Well, if we actually go down to that position, let's just look at this real quick. The 20th, the WFC, just quickly, tell me if this is showing potential sell signals. Now, let's go look and see when it was put on. And I want you to grade the entry. 20th. It was right here. Now, when I say here, it was on this date. Now, sometimes, very rarely do I show examples like this, but sometimes some investors, they like to buy right near an area of support. I'm not going to say it's always going to work out like this, but sometimes people say, look, I like to buy. I don't care if the moving averages are red. I want to buy into an area where I'm actually expecting a bounce. Doesn't always work out like this. Now what you're going to see in the next 2 days, we actually get that cross, but it took a week for it to actually get a little bounce. And all of a sudden, it start to get a little push. Moving averages go green, get the shading, and all of a sudden, and down the stretch we come, and it's filled in the gap now. And now we're asking ourselves, well, how much higher could it go? Okay, there's the fill in the gap. And now going back to the old high, 96 and change. So we don't have a sell signal on Wells Fargo yet. Some investors might think, look, I think that upside might be a little bit more, about another $1.70-ish. And if someone's trying to sell into resistance, then if they're trying to sell at a target. Also understand as we come up closer and closer to the target, remember what we talked about as far as reward to risk stop methodology. The closer you come to the target, the bigger the potential risk. So be aware as far as stop adjustments. Now, let me show a couple stocks that I just want to kind of make mention of today, okay? Keep an eye on, let's say, Intel has had a very unusual rise here. Intel tells investors, look, we didn't do as good as we thought. The stock actually gaps down. What's the reaction 2-3 days after that earnings? People are buying into the softness. Why do they do that? Because they think the expectation is going to change over time, or the materiality potentially of the earnings is going to change. Keep an eye on actually Intel. When you look at XOM, not weak. Twin cousin, Chevron, it ain't weak either. Probably the one that's lagged that actually might be on the cusp of a potential thrust, if it could with its other names, might be ConocoPhillips. Now, we also take a look at, let's say, what might be some companies that might try to fill in the gap like a Wells Fargo. Keep an eye on Citi and Bank of America. And those two, C and Bank of America, might get the push. And the last one I'll make mention of, okay, is GM. That is the one that is kind of in a striking pose where it's kind of like right at resistance, but it's not falling down either. And the longer we could stay up at the resistance, the greater the chance that we could break to the upside. Many investors might be really watching GM to see if it could push to the upside. Keep an eye on that. I'm out of my time here today. Want to say thanks for your comments and your participation. Did look at a couple of examples here today and a follow through. We haven't changed our posture, but there definitely is some weakness in the NASDAQ space. Continue to watch and see leadership from the Dow and also base materials and transports. We got Cameron May coming up next. Thanks to Barbara. She'll come up later on getting started with technical analysis. If you have not subscribed to the Traders Talk channel, do so. It's free. Just click subscribe. And again, I'll be back on tomorrow morning, same time, same station. And also, there's a survey in the chat, and thank you so much ahead of time for filling that out. And again, thanks to all. Stay tuned for Cameron May coming up next.